Hey guys, welcome back. It is Wednesday, live at 5. Jeb Smith, real estate broker here in Southern California. We got Josh Lewis with us. Sorry guys, I can't breathe. I literally ran from my car to get here in time, to start on time. So appreciate you guys being here. Josh is with us again tonight, and Josh is in a hotel room in Salt Lake City. So Josh is also committed to helping you guys as well. Josh, welcome to the show, my friend.
Thank you. That should tell you about the nightlife midweek in Salt Lake City, that we're happy to be here on YouTube talking about housing and mortgage and interest rates and all that fun stuff.
Well, I just figured you were committed to the cause, and that was the
That's what I'm
primary reason
saying.
that
No,
you're
100%. It has nothing to do with the lack of anything enjoyable to do. If you're in Utah and you're from Utah and you like Salt Lake City, I am not disputing it. We've had a couple of fine dinners, but there's not a lot of action around here.
No, good stuff. So appreciate it. Got a couple people in the chat room already. If you guys are watching us, let us know where you're watching from. Let us know your questions. Not really a lot happening this week with regards to news, at least that I'm aware of. During the show, we're obviously going to touch on things that you guys want to know, interest rates, things that we talk about every week, the direction of rates, maybe what's happened in the last week or so. And Josh can give us a little bit of information on that, but we'll wait till the end of the show before we do that. But we'll start here and start diving into some questions. We got some people here already. Jennifer is here moderating the chat. So thank you for being here, Jennifer. As always, if you guys don't behave, she'll take care of you. So Matthew Bain, first question of the night. How do investments play into your qualifying for a second mortgage to purchase a new home as a primary and turn current into a rental? Are they considered assets, or do they want them cashed out? And then he goes on, not willing to do that, but curious. So Josh, if I'm buying another home as my primary, I'm turning my primary into an investment. What does the lender need to see? How do they qualify it?
So if we're not going to cash them out, we're obviously not using them for funds to close. The only thing we would use them for at that point is reserves if they were needed for the loan program. Since we're talking about owning a home and turning it into a rental to buy a new primary, it's likely, or I should say probable that you would need reserves, and those funds are absolutely usable for reserves, and without you needing to cash them out. During COVID, some of the programs came with some overlays where we had to take a haircut on those funds. So if you have $100,000 in your stock account, they were making us take a number less than that just because of the volatility. But for the most part, if it's in an account that can be cashed in, we can give you 100% credit of that. If it's in a retirement account, sometimes we still do need to give you a haircut. So talk to your lending professional, let them know what you have. They can walk you through whether you need reserves, that the funds that you do have are usable, and whether we can use 100% or we take a percentage of them.
All right. So good stuff there. Hopefully, well, Matthew, that answers your question. We got a regular user on here, or a regular viewer on here. We got two regular users. But Michael Duree is a regular viewer on here. Thank you for being here, Michael. He's stating, builder stated that Monday that the buyer's responsible for the survey fee. Is that a typical practice for a builder to pay for the survey?
To not pay for the survey.
Oh, to not pay for the survey. So I'm not sure what they're charging you with regards to a survey fee. If it's a small fee, then it's probably something that's customary. I mean, I know you're in Texas, or you're purchasing in Texas. So, that's here in California, I don't think you're going to pay a survey fee on new construction unless it's a small fee. But surveys can be expensive. Getting a survey on a property for property lines here in Southern California can run you $5,000, $6,000, $7,000. At the minimum, depending on the size of the property, the lot, and all that good stuff. So I'm not sure exactly how much that fee is, but it's something to go back through that contract that's probably 100+ pages that you signed when you were buying that property to see what they are responsible for and see what you're responsible for. It should lay it out there pretty clear. So hopefully, you still have that documentation. You can reference it, but chances are if they're telling you that, then that's probably the case.
We got a couple of them here from Tanner Preby, and they're kind of related. So let's start with his first question is it becoming a buyer's market? And then the follow-up here is, how safe would you feel selling in a month? So why don't you jump in on that one there, Jeb?
Is it becoming a buyer's market? The easy, quick answer is no. It's definitely not becoming a buyer's market. But what I will say is, as inventory increases, which it is starting to do in several markets. I mean, I've seen it here locally in Orange County, locally in Huntington Beach. Now, when I say increasing, I'm not talking about a substantial increase. I mean, there's noticeably more property on the market, but things are selling very, very quickly. So, it is not a buyer's market by any stretch of the imagination in most of the markets that I'm familiar with. But it should get a little bit easier, maybe to get an offer accepted as more property becomes available, because you have more inventory, you have more options. You've got people bidding on multiple properties versus just one property. So all of the focus isn't on that one; it's spread across many. And so I think that will give buyers more of an opportunity to get in, and it might make buyers feel like they're getting the upper hand because of how tough it's been. But don't get confused that it's a buyer's market, because it's not. And the second part of that question is how safe would you feel selling in a month? As safe as I would feel selling right now. I mean, I don't see much changing in the housing market in the next month. So I would say that I'm pretty confident, regardless of where you are, you're probably still going to be in a good position to take advantage of the market if that's what you're looking to do. Josh, anything you want to add to that?
Just in terms of, is it becoming a buyer's market? The general definition of a balanced market is 6 months of supply of homes on the market. Above 6 months is a buyer's market. Below 6 months is a seller's market. We're monstrously below. So when Jeb says we're seeing more inventory come on the market, we're seeing more months of supply. At one point, in our market in Orange County and in many parts around the country, we were under 2 months. So it's like a minuscule supply of homes. So now we're in the 2.5 range, or sometimes even less. So it's not even to the point of being close to a neutral market. It is still a strong seller's market, just less strongly so than where it was earlier in the year. And it makes sense. If you look back, we had a lot of people in 2020 that were planning to buy a home, and they got put on the sidelines for 3 months, 4 months, 5 months, 6 months. At the same time, we had sellers backing out of the market because they didn't kind of know what was going on. So we had a much lower supply. And then we got to the fall and the spring of this year. All of those buyers that wanted to buy last year, they didn't just go, hey, I don't want to buy. And once the coast was clear, COVID-wise and economy-wise for them with their jobs and their savings, all of those people poured into the market at one time. So any measure you look at, we still have historically strong demand and historically low supply. So I wouldn't expect a buyer's market anytime soon.
No, and you're going to continue to see demand weakening, right, compared to the numbers, right? Each month that goes by, they're going to show I mean, for the most part, buyer demand's probably going to decline a little bit, but you have to understand where it's declining from. I mean, we saw record growth, record appreciation in a lot of markets, record demand in a lot of these markets as well. And as more property comes to the market, people start taking vacations now. People start, maybe taking a break because they did have to put in multiple offers or whatever the situation is. Things are, it's cooling a little bit, and that's okay. But when I say cooling, I'm not talking, it's not cold. It is still a competitive environment. Don't expect to go in and win the first house in most cases. I mean, it's still going to be competitive. So keep that in mind as you move forward now. But chances are, as you've probably seen the worst, in my opinion, of inventory levels. I don't think you're going to see inventory levels going forward anywhere close to where we saw them. So I think we're out of the clear with regards to the super anemic supply levels. But the people are going to continue buying. People, it's right before school. People are going to want to get their kids in the school district and that sort of thing. But as you move towards the holiday season, typically that's a slower market in a lot of areas. You might see a little bit more cooling down and at that time as well, which will give those inventory numbers a little time to build, maybe even more. So it's going to be difficult to say how long it lasts, but I think you got a little bit of time before. And when I say a little bit of time, a year or two before you really start to see, anything close to what would be considered a buyer's market.
You got longer than that, so we can debate that if you'd like.
No, I don't think it's worth it. I mean, a debate at all. I agree with you. I just, I don't want to.
And the reason why I say that, Jeb, is I saw 3 different headlines. So I'm here with my business partner Scott Shang in Utah. When we get up this morning, I'm thumbing through my Google feed, and just 3 of the most insane headlines you've ever seen. almost equivalent of the headlines you see on YouTube videos when you're scrolling through the clickbait of people talking about the housing crash. These were major, like Market Watch and two other major publications talking about how the numbers are showing this housing market is rapidly cooling. You're like, we're coming from an absurdly hot market. So the only cooling that you're seeing is from a ridiculously, like no one has hardly ever seen, other than a couple of months in 2005, 2006, when you had really ridiculous lending and a hot market and a lack of supply. So we talk about this all the time on the show. It's a supply and demand issue. There's not supply coming and there's not demand withering. Demand may diminish some, supply may increase some, but we're so far from a neutral market. And again, I'm not sitting here and cheerleading a hot market. For us, for Jeb as a realtor outwriting offers, for me as a lender putting pre-approval packages together for those offers, I want nothing more than a balanced market where a good buyer can go out and make 2 or 3 offers and get an awesome home under contract at a fair price. This sucks for us as much as it does for you guys. I'm just being realistic and looking at my life going forward. I would love to approach a neutral market, but I just don't see the factors coming that are going to change that. So if we could get to 3.5, 4.5 month supply, that would be fantastic. Still a seller's market, but much closer to a neutral market. And coming off of the craziness of this winter and early spring, it would feel like a buyer's market to most of us at this point.
No, absolutely. And I'm going to go to this comment real quick because I'm going to just knock it down. So Doc D, national inventories have rocketed to 5.1 months. That's false. That's not true. I'm not sure where that information is coming from.
Probably one of the absurd articles I read this morning.
Yeah. I mean, inventory levels at the moment are nationwide or maybe 2.5 months. I mean, you're still well half of what you just mentioned there. So, I'm not here to argue it. I read this stuff daily. So, Jason Walter is joining us from Sacramento. So Jason, also a fellow YouTuber up in Sacramento area, has a great channel. California real estate. If you're looking on anything California, provides a lot of good information out there a couple times a week. So check him out on that channel. Logical Thinker's got a good question here, Josh, something that has come up quite often lately. And something that we can address, and we can either address it now or we can address it when we start talking about the direction of interest rates. But what will happen to mortgage rates when the Fed stops purchasing $40 billion of mortgage-backed securities? So currently, they've agreed to continue buying these mortgage-backed securities at a very big amount on a monthly basis. And I don't even know if they've actually hit the number that they said they were going to hit. I know that was a question in hand at one time, but what happens when they start tapering that back?
So a couple of things that are important to note here. A decision has not been made. You talk about comments from Fed governors, Fed presidents that are in the media, all saying that, hey, we think this would be reasonable, that the economy is pretty stable right now. We don't need stimulus, and we don't need stimulus in housing. It's already stimulated enough. So they're going to do this at some point, probably starting late in the year, early next year. So we're not close to that. If the bond markets thought that was imminent or a danger, we would be seeing bond yields on the mortgage-backed securities increasing, and we're not seeing that. So what will happen is they will back away very slowly. They're not going to take $40 billion away right away. They're not going to do it for 6 months or so. And here's the important part to say. If they took $40 billion a month away immediately, there would be a spasm in the market. If you go back when they took away quantitative easing in 2014, after a year and a half, 2 years of buying mortgage-backed securities, they weren't very transparent in what they were going to do, and it spooked markets. The markets were convinced they were taking away the punch bowl all at once, and we saw bond yields spike in a very short period of time. They've learned their lesson. They will not do that again. They can and should back away from buying both mortgage-backed securities and treasuries. And what will happen, all of the discussion I've seen has mentioned nothing about treasuries. They will probably be all the way out of mortgage-backed securities before backing away from treasuries. So what happens is, if there's not enough supply to absorb, or enough demand to absorb that supply without the Fed buying 40 billion, yields will rise. So yields on mortgage-backed securities, and therefore yields on mortgage rates, will rise. But what happens is, when they get too high relative to treasuries, so treasuries are staying low, mortgage-backed securities rise a little bit, then you start having investors go, well, I kind of like that extra yield. So it creates the demand. They're never going to get too far away from each other. 10-year treasury and mortgage-backed securities they're not tied to each other. They're not locked to each other, but the markets keep them tied together, because if the yields on mortgage-backed securities get too high relative to treasuries, then people will start buying them. If they get too low relative to treasuries, they'll stop buying them. So we see a pretty consistent figure over time that it ends up, at about 1.3% above. So in terms of actual mortgage rates, so long way of saying, there could be a little disruption. The markets will figure it out, but the markets are not concerned about it right now, and I would not be concerned about it in the long run. The markets don't need the mortgage, the government buying to keep yields low. The deflationary factor over the long run, despite the fact that all we hear about is inflation, 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 the markets are looking much further out, especially when you're talking 10-year treasuries, 30-year mortgage-backed securities, and they are not concerned about inflation, and that's why rates are low right now, in addition to the Fed buying. So I wouldn't worry about it. It's definitely something to keep an eye on. We probably should talk about it every couple of months here as we get closer, because it's going to happen, and it will have a little bit of disruption in the short run. But right now, absolutely nothing to worry about.
Got it. So John kind of had a question that was similar, asking about mortgage, interest rates with, what's going to happen, anticipating the 2022 taper and all that good stuff. So without reading that entire question, pretty much answered it there. And we'll address the interest rate question in a little bit more detail as we get through this. So John will come back and give you a full answer on that. Let's see here. Doc has another one saying 65% of buyers saying the housing market is overpriced. Who cares? I mean, at the end of the day, not to be like, but it doesn't matter, right? It doesn't matter what home buyers think if they continue to buy property. And the thing you have to keep in mind with these surveys is, who are they surveying? Where are they surveying these people, right? Are these people, what price range are these buyers in? Because people continue to buy property. People continue to put in offers, multiple offer situations. Here in California, one of the biggest changes in the environment is people purchasing properties over $2 million, right? It's jumped, I think, 300 or 400% in the last couple of months. And, or in the last year, a year over year, rather, it's up considerably. Whereas properties under 500,000 have dropped considerably. But the reason that the properties under 500,000 have dropped considerably is because there are none, right? So there's a lot of ways to skin a cat, if you will, and there's a lot of ways to read into these things, and the media can make things portray, they can make them look however they want them to look. So the fact that 65% of home buyers think the market's overpriced, but yet home prices continue to accelerate, I think, take that with a grain of salt.
You go back, Jeb, and it's just, again, everything, even what used to be traditional media, it's clickbait. So what you can put in a headline, you can go out and do a survey, and I have no doubt that a lot of people think housing is overpriced, but they're still buying. Demand is there against low supply. But what we're seeing every day is the media trying to scare the shit out of people with crazy headlines that don't match the underlying fundamentals. We keep hearing about affordability. So home buyers feeling that homes are overpriced is because they are much higher than they were a year ago. So if something goes up 10 or 15% in price over a year, you're going to go, this sucks. So it's easy to call it overpriced. But the reality is, when you look at historical trends, we're right on trend with where home prices are, maybe slightly above. But with mortgage rates where they're at, affordability, which you also see headlines that the media loves to throw out there saying, oh, affordability with these prices so high is at an all-time low. It's not. Homes are much more affordable than they were in 2000. So go back 20 years ago. And what does affordability mean? It's the measure of income against mortgage payments. Mortgage payments are impacted also by interest rates. And when you look at it that way, we've talked about this a million times on here. People don't care what the price of their home is. They care what their mortgage payment is, and can they afford it based off of their current incomes. So the reason why people are still out there buying, the reason why demand is still high is one of the things I always like to talk about, there's willing and able demand. There's always willing demand to buy beachfront homes in Malibu. There's just a limited amount of able demand. So we always have demand. Right now we have plenty of able demand. I would love one. I can't
I
afford
would,
it.
yeah, exactly. I'm not able to buy that.
But so looking at it right now, we have plenty of able demand, more able demand than we have supply of homes. So regardless of what people think or what the media can spin in an article that affordability is bad, we saw numbers existing home sales year over year up 13%. So if they think it's 65% overpriced, okay, cool. 13% more sales than this time last year. So that's in a really limited supply market. Look at the actual real numbers of what people are doing. I'm not real concerned with what people say. It's sort of like you go back to the last couple of elections. We see these giant spreads in the polls saying Hillary's going to win, Trump is going to lose. And both times he either won or came really, really close to it. So what people say to pollsters and what people do in the voting booth or out in the housing market are often two very different things.
Very good. Richard here. I think Richard's in Huntington, missed the last couple of weeks, still in the market. But with that said, I mean, I thought I would just touch on the local market here just for a minute because, we talked about demand increasing and, or not demand. I mean, I mentioned, let me start over. A moment ago, we talked about demand possibly decreasing, or there was a comment about that. But I said, inventory levels are going to increase a little bit. So I just looked up available inventory here in my local market, Huntington Beach. And I've been following it pretty closely for the last year or so. And as of a couple of weeks ago, we had about 120 active homes on the market. And that includes condos, townhomes, single family homes. So that's, we're a town of just over 200,000 people. We've got 120 homes on the market. You can do the math, or we did a couple of months ago. We got up as high as about 3 or 4 days ago to about 150. So, we went from 120 to around 150. So that's 30 more homes. What's that? 25% more properties on the market at that time. So supply had increased by nearly 25% at that time. But you start looking at, okay, how many of those homes were under 500,000? How many of those homes are priced, below $1 million or whatever? And the number is still really small. A lot of the properties coming on the market are luxury homes here locally. But when I just looked at the numbers, it's dwindled down to 139. So we went from 153 down to 139. And at the moment, there's only 83 single family homes on the market in my entire market. And it's been around 80 the entire time. So while property has come to the market, it's not single family homes. It's a lot of condos and townhomes. So depending on what you're looking for, make sure your agent's following the trend and, they can give you a really good idea of what's happening in your market, and it'll help you make informed decisions, right? I mean, if you just looked at the inventory levels and said, oh, well, inventory is increasing, you might think, well, I don't have to be as aggressive when I make an offer, or I might have these options in doing it. And that might not be the case depending on what types of property are actually coming, are adding that supply or making that supply number go up. So just a side note there, but the reason I brought that up is because Richard mentioned it's still a tough market. It is, but inventory levels have increased a little bit, and I see them increasing more. So hopefully some more stuff will come out for you. Michael's got a question here. Josh, can you pay double the mortgage payments each month? Do all lenders allow you to essentially pay more each month to pay down the principal on the loan?
For the most part, the answer is yes. Really, what would prohibit you from doing it would be a prepayment penalty. Making double the payments would come nowhere near triggering a prepayment penalty. In California, and I would assume most all states, the laws generally limit a prepayment penalty on a primary residence to 20% of the balance. It's a 5-year prepayment. You can pay 20% of the balance off in any given year, and you wouldn't come close to triggering that. But more importantly, with double payments, hardly any loans have prepayment penalties on them any longer. They're non-QM loans like bank statement loans, and even most of those don't. So a prepayment penalty for a primary residence loan is incredibly rare. They're really just in commercial loans at this point. So yeah, you can absolutely make double payments with any lender that you choose.
All right, there you go. SDN, in regards to new construction, when will the lumber shortage? I can't talk, dude. I just played. let me back up here. So I went and played golf. It's a friend's birthday. I left. I thought, you know what? I've got plenty of time to make it back by 5 o'clock. No stress. Coming up 18. I've got about 15 minutes to get from there to here. So I'm like coming in hot. and I rushed to the mic and here I am. But anyway,
So
long way of saying,
what do you think happens at a
my heart
birthday
rate's still
party
up.
on the golf course? I don't think it's heart rate. I think
My heart
we're a
rate's up,
little
bro.
couple brews into the
I'm actually
afternoon.
not. I'm actually
Couple
not.
birthday brews,
I
White
didn't drink.
Claws for the ladies, some lady beers.
I did not drink today because I knew I would be here and I wanted to be fully aware and alert for everyone watching. Let's see here. So he's asking when will the lumber shortage correct itself? So lumber was as high as what 1,700 board per foot. A couple months ago. Now I think I just looked it up. It was 737. So we're down considerably from the highs. We're not quite to where we started back in January of 2020, but I think we were at 400 or so at that time. So we've come down considerably at this point. Part of the problem is that, your Home Depots of the world, your Lowe's of the world, your building supply companies of the world buy lumber in futures. So a lot of what they have in stock, they paid a lot of money for. They paid at the highs, that 1,700 or whatever that number was at that time. And so their cost is much higher than the current price of it, but yet they still need to sell that lumber. So they're going to have to go through that lumber before they can start to, before you really start to see the price reflected in the market. And so it'll happen. How long is it going to happen? It really depends on how much of it they bought at that time. Did they think it was going to continue rising and therefore they just stocked up on this stuff and have tons of supply, or are they able to get through it? And you'll see prices sooner rather than later. It's hard to say. I mean, I don't know the answer. Maybe Josh does, but each month that goes by, you're going to see lumber prices continue to go down. I've talked about it before in here. I bought a sheet of plywood, 3/8, 5/8 thick. I don't remember the exact thickness of it, but it was like $90 for this board, which should have cost me about $10. I haven't been and looked at it lately, but I got to imagine the prices are starting to come down, and you're going to see it across the board, which means that, builders also buy lumber, in bulk and futures and what have you in some of these cases and buy a lot of it. And so they have to work their way through that supply as well. But you should start to see prices come down, with the supply chain correcting itself and all that. And Josh, anything you want to add to that one?
I smiled when I saw the question because right before we came on here, the headline popped up on my phone. CNBC: lumber prices dive more than 40% in June, biggest monthly drop on record. And I think we talked about this a week or two ago. There was nothing fundamentally pushing prices that high. There were supply chain issues, and then speculators pile in, and you end up at a certain point where it sort of feeds on itself. So on the opposite side, when it starts going down, you get everyone who had those long positions, as it drops and drops and drops, they get squeezed out of it. So Jeb's 100% correct. We just have to watch and see how long it takes the prices from the futures markets, which are correcting back to where was much more normal, to trickle down to retail prices, both for builders buying and for you if you run down to Home Depot or Lowe's to do some home improvements.
Got it. Joey Crack is here. Joey and Josh are best friends, if you guys didn't know, like BFFs. They probably text each other off air, but Joey always shows up to talk to Josh. But tonight he's talking to me, Josh, and he's asking me about a playoff beard. This is not a playoff beard. I'm not a Clippers fan, not for any reason. I mean, I'm rooting for them because they're in it. I don't like the NBA, if we're going to be completely honest here. So I don't
Jeff,
have a team.
Your chances of getting invited to Clippers games in the future are dwindling rapidly.
I get tickets offered all the time. I turn them down. I'm like, NBA is a bunch of sissies. I don't want college basketball is where it's at. But anyhow, is this a playoff beard? It is not. This is a lazy man's beard. This is a guy that got tired of shaving and decided that he was going to grow a beard, and here we are. So that's what it's about. How long will it last? That's a really good question. This is about the furthest I've ever grown it out. I can't get past this stage because when I look at myself, I stop. I don't even like it anyway. And now, anyway, another question.
We should probably pull pictures out for Joey of my hacksaw Jim Duggan beard that I had back in the day. We'll maybe next week.
No, I think I could find one. If you talk long enough, I could probably find one on here. But Practitioner has a question, and this is something I knew would come up, and I'm glad that we could talk about it. So there's a lot of misinformation right now floating around the interwebs, if you will, about 40-year mortgages, right? There was a headline that came out yesterday that Ginnie Mae is now, offering 40-year mortgages. What does that actually mean, Josh? What does it mean when you see that headline?
So what they're doing is changing the pools where they securitize Ginnie Mae bonds. So FHA, VA loans get sold in Ginnie Mae pools. So all that this would allow is for modified loans to be securitized and sold in the secondary markets. There are no plans for FHA or VA 40-year mortgages. It's just sort of a behind the scenes thing. And even at that, I know some people that know this stuff way better than I do that are on the secondary market side. And they're like, who would buy them? Why? These are non-performing loans that were either in forbearance or non-performing and had to be modified. They would need to be on the books and performing for quite some time before there'd be a value into them. Most servicers just decide, we'll keep it on the books. We're not going to eat this loss. Let's see if we can get them performing and make them better in the future. So unfortunately, or fortunately, we're not going back to having 40-year mortgages. Right now, 40-year mortgages do not meet the qualified mortgage definition. So 30 years is the longest that you're able to have. And if you look back, Jeb, historically, the last time we had these was in 2005, 2006, before the meltdown. Yeah. And we had home prices high. Rates were much higher, 5.5%, 6% at that time. And at that time, with rates that high, they're a terrible idea because you're paying so much in interest every month that you're only saving a tiny bit on your payment by stretching it out. Now, right now, if you were able to get a 40-year FHA loan at 2.5%, that rate is so low that the 40-year doesn't really hurt you. You get a nice savings in the monthly payment, and your total payment by adding, 120 extra payments onto that loan doesn't exactly crush you. But we're going too far into detail because there's no such thing as a 40-year mortgage, and I don't see it on the horizon. Politically, anything is possible. Where are we at right now with the winds of politics? We have politicians in Washington, D.C. who have once again decided that homeownership is a great benefit. It was different in the late 90s when we both had Democrats and Republicans pushing homeownership at all costs, which led to the meltdown in 2007, 2008. The big cry now is that lack of homeownership creates income inequality. So we need to get more people into homes to decrease wealth inequality. And everyone is in favor of that. You hear that and you go, oh, I'm in favor of that. But we shouldn't do it by getting loosey-goosey with mortgage guidelines, programs, regulations, which anything's possible. I hope it doesn't happen.
There you go. Clearly, there was a lot of people on here waiting for that question to come up because I think we were at 220 viewers. And then once we said there are no 40-year mortgages, it dropped like 30%. Now there's like 160 people watching or something. But anyway, clearly that was something that people wanted to know and weren't happy with the answer because they left. All right. So Nathan here has a question. It seemed that prices went up due to FOMO and people willing to bid up prices. Do you think there could be FOMO going the opposite direction where sellers think the market prices are dropping? I mean, maybe there could be sellers that think that think they missed the opportunity, that think, because their house is sitting on the market a little bit longer, that they need to drop the price. But, that comes down to their agent, their real estate agent, educating them on what's actually happening in the market, what's happening in their local market, what other homes are doing. Are they priced right? It's communication with sellers. But I would say as the bulk, most sellers aren't just going to come out and drop their price just because things are sitting a little bit longer, or at least they shouldn't. Here in California, our average days on the market for the last 2 months have been 7 days. So 7 days on the market. And if you've heard me talk about this, that's the time that it goes from active to pending in the MLS, the multiple listing service. So you've got to think it's much less than that because you've got negotiations going back and forth, them going through multiple offers to figure out who they're going to accept or what have you. So most homes are selling in a couple of days, 3-4 days probably. So a home sitting a little bit longer is probably a good thing for a lot of people. And just because a home sits a little bit longer doesn't mean they're not going to get their price. So I don't think that sellers are going to just go the other direction with this. And I will also say, part of what drove up prices was FOMO to some extent, but not really. It's supply demand. It comes down to the basics of that. Now, you got people going well above and beyond the asking price in some cases because of the FOMO and driving up those prices, but that's not what happened in every market across the board. Josh, anything you want to add to that one before we move on?
Not really. I like the question. It would seem logical. What we've always seen, back before the last meltdown, the national media, the saying was that home prices have never dropped year over year in the United States. So that's looking at the entire country, but largely the other saying was that home prices are sticky to the upside. Sellers do not like selling at a loss, even if that loss is not to their purchase price, but to what it was worth or what their neighbor sold. So sellers, for the most part, will hunker down and just wait until prices get back to where they were or go up. But it's certainly possible. It's a hypothesis I'd like to look at least to some degree. The people who were, who would be most susceptible to that, Jeb? It's the person that says, I'm going to wait till the end of summer. I don't have to go to move for my new job until December. I'm going to wait and put it on the market in November. Those people might say, hey, it's not quite as hot. We're not getting as many offers. Let's just get it on the market and be done with it.
No, absolutely. And you'll have some of that, but I don't think that's going to be, you're not going to have the drop because of FOMO going the other way. At least I don't think so. Grace, who is normal. Why do I say normal? A regular viewer on here, normal as well. Forbearance and foreclosure moratorium have been extended until September of 2021. So that's in California, guys. That is not across the board. It is the end of July is the federal ban on evictions and foreclosures. But here in the state of California, it's extended until September. Once these recipients have received the government aid that's needed, do you think that there would be another extension? California, maybe. Who knows, right? I mean, I think based on what I read in the last one, and Josh will probably, we'll have this conversation now, but they essentially added verbiage. Every time the Fed meets and they put out their statement, if you will, people analyze the statement and they say, okay, what words changed in that statement? And they try to read into what that means and the direction of future, adjustments to the rates or what have you. Similar thing here, except for nobody read into it except for me, right? And the added verbiage was that essentially they said that this was the last extension. Now, is it the last extension? I'm going to go out and say, yeah, because they've never said that before, which makes me think that they're kind of drawing the line in the sand. Could that change? Absolutely. In the state of California as a whole, I think you got a better opportunity of that changing more than the federal one, just because of the politics involved with everything going on, recall elections, people wanting, votes and what have you. Completely different discussion there. But Josh, thoughts on this whole thing? Extensions going forward. At one point, we talked about 2022 was your guess?
At least past the next elections. Everyone wants to get all their votes. So there's not a cost to politicians of saying yes and extending and kicking the can further down the road. So no one's stopping and looking at any of these policies and saying, are they necessary? Are they needed? And when I say that, don't go, hey, Josh is heartless. There are certainly people who will benefit from it. There's just such a small number that there's better ways to help them than blanket more moratoriums like we have.
Got it. I'm just reading these crazy comments here that I'm not even going to take the time to address. Hi, Jeb. Do you have an idea for a gift for a realtor? Anything a client has gotten for you that you loved? So, here's the thing. I don't really, I don't think most realtors expect gifts. I don't expect a gift. I just want a happy client that had a great experience. And when their friends, family, anybody they know thinks about selling, they bring up my name. That to me is the best gift that you can give any real estate agent. So I would say that's first and foremost, but maybe try to find out what it is that they like. When I'm around buyers, we obviously have a lot of conversations about different things, hobbies and what have you, because I'm trying to get information from them so I can think of closing gifts. And a lot of times I'm talking back and maybe they've mentioned something of something they enjoy. Josh likes 805. He mentions it every week. You could buy Josh a case of 805 and he would be happy. I don't think any of us expect anything, so I think any gift, would be welcome. So I don't overthink it. That's what I would say.
A piece that I would say is definitely go online and leave a 5-star review and tell other
Yeah.
people details about how experiences. If you just hit 5-star, people can go, oh, he had his cousin go on and leave 5 stars. But if you give he or she, if you give a detailed explanation of what was your situation, where were you coming from, what did they help you solve, what was awesome about working with them, that is worth its weight in gold.
Got it. All right, here we go. Let's see here. Let's move down. All right. Kyle Stauffer. Anyone want to play the bank for me? All the houses around. Blah, blah, blah. Okay, so we're gonna move on there. Kyle, unfortunately not, my friend. It's tough these days. Here we go. Live in Illinois, looking to buy or build in the next 12 months or so. Which would you do if you were me? Seller's market versus lumber prices of building. So would you buy existing or would you wait to build? Josh, what are your thoughts on existing versus new construction?
They're just so different for the most part, unless you can get something recently built. I mean, the biggest difference with an existing home is it is what it is. Any changes that you would want to make, it's an addition, it's a remodel. With new construction, you have more say and more input. It's a little bit different process. You're negotiating with the builder versus a seller. They generally have more than one of them. So if you're willing to pay the price they want, you can get one if you want it. They're just so very different. For me, it's just hard to say. Where Jeb and I live, there's not a lot of new construction, like almost none. And when it comes on the market, it's at absurd prices. So the neighborhood behind me, there was a little infill project. Jeb, that little thing over there they built by me, was it 30 houses, 40 houses over there?
Yeah, something like that.
They're $700,000 more than the homes around us. They're newer, they're bigger, they're on smaller lots, and they're packed in super tight next to each other, and people are absolutely paying that premium for it. So it's hard for us to say. For the most part, I would prefer an existing home, but it's totally case by case and what you value in your family. And probably the most important part is what your wife values if you have one.
Always. Let's see here. All right. So there seems to be some conflicting information here. So Doc D is looking at the Fred. Let's see here. From the St. Louis Fed, the months of supply showing 5.1 months. So I'm pulling that up at the moment. But I'm also looking at the National Association of Realtors months of supply as well. So give me a little bit here. It's going to take me to put all this in, but we will address it. So Josh, anything you want to add to that about or address another question while I look this up?
Okay. Yeah, no. And absolutely looking, next time you're looking at what the media ever quotes, again, we've been bashing the media here, but the consistent number that's used is the National Association of Realtors. And more importantly, it's your local association. So the NAR, like for us, we have the California Association of Realtors. The NAR is pulling those numbers up. And what is not important at all would be a national figure. What matters is in your area and your market. If we're, Jeb just ran through the numbers of supply and demand. We're a little over 2 months, like we're talking about 2.3, 2.4, 2.5 in Huntington Beach and probably Orange County specifically. That's the number that matters. It doesn't really matter how long it's taking in Nebraska or Maine when you're looking to buy a home in California or Texas or Florida.
No, absolutely. Yeah. So Josh, here you find a question. I'm reading this thing real quick. I'm trying to find the inventory here.
Okay. We'll get one figured here.
I'm looking for the actual thing so I can bring it on the screen, so it's not just me talking numbers off the top of my head. It'll give me a minute here. Yeah.
Again, always be careful with anecdotal information, but Ray Campos here shows up often. As Jeb would say, he's a normal viewer. So Riverside County is still crazy, and Lake Elsinore houses sell in a few days. I've had 3 buyers make offers this week. All of them made very aggressive offers. All of them did not get the house, and all of those homes had been on the market for a couple of days. So again, that's anecdotal evidence. What I don't have is any buyers out who have written an offer, not been in a competitive bidding situation, and been able to name their price. So that's the issue that we're looking at from that end. We've got another one here. We have, I expect the SoCal area to keep going up. People leaving from Anaheim area to Corona Riverside and even further out. So many people in California, not enough homes. Again, what is he saying? Supply and demand. Southern California, Texas, Utah, where we're at right now, Nevada, Arizona, Idaho, Oregon, Washington. We can name the state. Everyone pops up there. My area is crazy. So we have a person here talking about a mythical number or a crazy place where there's not homes being sold in a matter of days and at high prices, and everyone out trying to buy a home experiencing the exact opposite.
All right, here I'm trying to bring this up so I can do it, but it's bringing up my entire screen here. But anyway, what I'm looking at here from the National Association of Realtors here. So this is May's report. So total housing inventory at the end of May amounted to 1.3 million units. That was up 7% from April's inventory, down 20.6% from 1 year ago. Which was currently at 1.55 million at that time. Unsold inventory sits at a 2.5 month supply at the present sales pace. So this is unsold inventory. When I look at inventory, I'm looking at properties that are not under contract, that are not pending, that are not, showing backup offers, what have you. I'm looking at what is available for people to buy. My guess is when you're looking at the St. Louis Fed, it's showing 5.1 months. My guess is they're looking at properties that are also under contract, properties that aren't yet closed. And so they're using that inventory level to add to their level. But I mean, you can't buy a property that's in escrow. So I've always followed the unsold inventory. So, I mean, yeah, you might be looking at information, but again, as I mentioned earlier, it's about knowing how to analyze that information and actually take it and use it. And quite frankly, to be completely transparent here, I don't know if that's how the St. Louis Fed numbers are calculated there with regards to that. I haven't read into it because I'm trying to read questions here and look at this, but I'll do you one. I'll do a video on this and touch on it so that we can make it clear. And I appreciate you bringing it up. So obviously a discrepancy there, but National Association of Realtors is where everyone goes to look at their data. They're showing 2.5 month supply, and that is pretty typical. Here in Orange County, where I'm at, I think we're about 1.7, 1.8 months at the moment, which is up a little bit, but still not anywhere close to where it should be. Anyway, hopefully that addresses that.
Got a question here, Jeb. Murray Wilson pops in with, why do some people not prefer VA home loans? So I'm actually out here in Utah for a meeting of a coaching group that I'm a part of. And this came up very first part of the day, Monday morning. And we have a veteran who is a loan officer. And he was pounding the table of how wrong it is that we're discriminating against veterans. And it is absolutely not a discrimination against veterans. There's 2 pieces here. One is just ignorance of government loans, period, government guaranteed loans, VA and FHA. There's a belief among sellers and a lot of agents, a myth, a mistaken understanding that they're going to have to do more to the property. They're going to have to pay costs for the buyers, in which those were true in the past, but both of those programs have long since been modernized. So other than some minor health and safety issues that VA or FHA would require that you might get away with a conventional loan, there's no reason against it. So when we get to the big issue, what is the big issue? Why do sellers not like VA and FHA loans? VA loans require 0 down payment, and FHA loan requires a 3.5% down payment. So if they get 10 offers that are all conventional 3% down, or VA 0 or FHA 3.5, there's not much difference between those. But if someone comes in with a conventional loan and they're putting 25% down or 50% down or 100% down and not getting a loan, no one's discriminating against the VA loan. The seller is ringing the cash register and saying, which is most likely to close, the smaller loan, which is less likely to have problems in terms of qualifying, and most importantly, which is most able to overcome any shortage on an appraisal. We talk about this every week. Appraisal guidelines were not meant for a rapidly appreciating market like we are in. So when you look at that, they're really just saying, I want the most certainty that this loan is going to close. There is a chance, if not a probability, of the appraisal coming in low. A veteran who doesn't have a down payment is unlikely to be able to cover any gap. And I want to make sure I get for my home what is agreed to in the bidding war that most of these homes are going in. So it's not a matter of not preferring VA home loans. They want certainty that it's going to close and they're not going to have to cut their price if it doesn't appraise. And the zero down VA is most likely to have some of those issues.
All right, there you go. Here's one from Princess Cut One. Is it shady to change how much you put down when you are in contract, say from 10% to 5%? I think we know the answer here. So here's the deal. Can you put in an offer on a property and change the financing terms through the contract? Absolutely. As long as, now here's the thing. This could go one of a couple of ways. Typically speaking, if you change the terms of the actual contract, the seller needs to agree to that, right? There has to be an amendment to the contract stating those terms, because sometimes, like for example, and Josh can tell us if this ever happens, right? Say if I have a client doing 20% down, they change to 5% down, I'm changing the terms of the contract, which means the loan amount's going to change on that contract. The lender who Josh is sending the loan to might request some sort of documentation saying that to show proof of that, so that the contract is valid. Some lenders may not require that, some may. If that is required, you need the seller to agree to that. And in some cases, the seller might go, well, here, look, the only reason I accepted your offer is because you were putting more money down. I'm not willing to move forward with this. I'm not willing to agree to that. And they might not do it. So you've got that on your, that the possibility of that happening. Now, could they just say, yeah, absolutely, and move forward? Sure. Could the lender never ask you for documentation of that? Sure. But there's a risk in doing that. And so you don't want to get under contract and then change the terms. If you think you're going to put less money down, I would encourage you to make that your original offer, so that you don't have to deal with this. But Josh, if somebody is writing an offer, you're representing a client, there's a change on the contract with regards to financing terms, do you need documentation in this market for that?
We don't get a contract amendment, but we will get at closing a lender rate and term amendment. And the funny thing is, I'm 99% sure our sellers do have to sign that lender rate and term amendment saying this is the financing that everyone is getting. It's an escrow amendment. We don't need a contract amendment, but the escrow instructions in California supersede the contract, and everyone does sign that. The biggest thing that I would say, I've had many situations where the financing has changed through the transaction. I've never had a seller refuse to go along with it, but when might they refuse to go along with it? We're in a crazy market. Let's say we're in the middle of January when prices are going up, and crazy bidding wars. You're a week from closing and you say, hey, my 10% is actually 5%, and they're expected to sign that amendment. And they go, well, wait, I could get another $20 or $30 or $40,000 for my house. I'm just going to say no and put it back on the market. So I've never seen a seller not agree to something along those lines, to a minor change to the financing, but they always could, because exactly as Jeb said, you are not closing under the terms of the contract. Just like if you have a 30-day escrow and it gets to day 31, they can give you a notice to perform, meaning close the escrow. And if you don't, then they can cancel on you. They can do the same thing in this situation because you're not performing under the terms of the original contract.
Got it. All right. Got the drone dad asking, do other sports other than the NHL do playoff beards? I'm not sure. Baseball, right? I mean, a couple of the pitchers, but not the actual people watching, not fans, I don't believe.
I think everyone tried to get in on it because they thought the hockey guys were cool, but it's really just a hockey thing. And if you do it in another sport, then you just look like a poser.
Guevara Guevara says Home Depot works by consignment. So all the lumber you see there belongs to the manufacturer. Like Sierra Pacific, Home Depot gets a percentage when the lumber is sold. So what they're saying there is the Home Depot is not actually buying the lumber. They're getting it from the manufacturer themselves. But what I've read is whoever's buying that lumber, the manufacturer, whoever is the one buying it in future. So there's a cost associated with that. So there's still a third party involved in buying that. And that's why you don't see the automatic drop in those lumber prices as, the market fluctuates on that price. All right. So who do we go? So big show. Smash the thumbs up button, folks. So guys, if you're watching, you appreciate the content, do me a favor, hit the like button. It helps more people see it. That's all we ask for putting in our time here. Toby, house listed yesterday and 27 total showings scheduled between yesterday and tomorrow. It's almost overwhelming. So, Toby, let us know what market you're in. That's pretty typical, in a lot of markets out there. So I'm not surprised to hear that sort of thing. Let us know the market you're in and the price point you're in. I think that would be helpful for people watching.
Got a good one here, Jeb.
All right.
Alex asks, with so many people refinancing at such low rates, as rates increase, is that going to further entrench established owners and prevent them from selling if they can't get an interest rate this low again? And let's look back historically. This is what everyone said in 2013 and 2014 when people were first getting 30-year fixed in the mid threes. Everyone said, this is crazy. This is a once in a lifetime thing. The Fed is doing all of this stimulus to try and get the economy out of the Great Recession, and we'll never see rates this low again. Sure enough, here we are in 2020, 2021, and now 2% rates for most people, and they're saying the same thing. This is going to make people want to stay in their homes forever. If you have a 2% rate on your $500,000 home, you may want to move up to a $750,000 home, but if rates are 4%, are you going to bite off another $250,000 of home and mortgage and an interest rate 35% higher than where you're at? So it's a good and valid concern, and it really comes down to what you think is going to happen with interest rates. If you've watched us here for very long, we talk every week that I believe we have much stronger deflationary or disinflationary. Deflation would mean actually prices going down. Disinflationary just means below what the government would like in terms of inflation over the long term, which is their target is 2%. I think we'll consistently fail to hit 2%. And as long as we're failing to hit 2%, interest rates are going to stay low. And the biggest reason for that is the massive amount of government debt, not only in the United States, but around the world. It's deflationary in that it decreases productivity, GDP, and therefore you just don't have the inflation that we've had in the past. So we'll see where it shakes out. I think we're absolutely likely to see rates go even lower from here. So I don't think that's going to be a problem, but it certainly could be.
Well, we've talked about this too, Josh, is that, they've been trying to hit 2% inflation for the last 10 years and haven't been able to do it. So, the likelihood of that happening going forward is not very high. But obviously, there's, again, it's whatever you're reading in the media with regards to inflationary numbers and what have you is where a lot of this information comes from. And unfortunately, a lot of it is not accurate. Marie is asking, should you waive an appraisal when buying a home? Should you? No, absolutely not. But in this market, is the possibility there that you might have to do it in order to be competitive? And the answer is yes. Talk to the last couple of offers that I've submitted for buyers, we've waived the appraisal, but we've waived it because I went out and I did the research. I looked at the comparables of that property, right? So my client said, this is the home I want to write an offer in on. I went and looked at the comparables and I said, hey, listen, these properties are ones that I would use if I were an appraiser to justify the value of this home. I think it could appraise for X. And in each one of these, the price was higher than it was listed. And every single one of these, the price, the value came back. So it wasn't a concern. But I always tell clients, hey, listen, here's the risk. The risk is it doesn't appraise. Are you okay bringing in the difference? You understand the repercussions of that. And, obviously they have to understand that in order to move forward with that. But, a lot of times I'll say, hey, listen, it's going to be tough. I don't know if it's going to appraise, but here, I think if it doesn't, it's only going to be, 5,000, 10,000 off in this case because of these comparables or what have you. And if they're okay with that, we move forward. So just make sure you're having somebody there look at the numbers, because the last thing you want to do is have something that's super far off, 50, 100,000, depending on the purchase price you're looking at, and you not have the funds available to do that. So you just need to understand the possible gap that may be there, so that you're prepared if something does happen.
Marie's on fire here with it, and actually some follow-ups here and just a number of good questions here. So she asked, again, in relation to why don't people like VA loans? What if the veteran comes in with 10% down? It's a different situation, because now you're showing, hey, let's say it's a $300,000 house. I have $30,000. The appraisal could come in up to $30,000 short, and you could still do a zero down and make up that gap. Jeb's talked about this before. That's where my job as a lender and putting a pre-approval letter together and him presenting that offer and making sure the agent that's listing the home for sale and representing the seller understands that. So definitely different than a zero down loan. Most of the problems we're seeing are zero down VA or 3.5 down FHA in areas where we're having problems with appraisals. So Jeb's very good at that. We always want to put as strong of a pre-approval letter together as possible, follow up with the listing agent and explain to them, hey, here's where we're at. And the biggest question I get in those calls that I have with listing agents right now when I'm following up on our pre-approval letter is, hey, I think we have comps here, but it's going to be tight. If we come in 10 or 15 or $20,000 short, what's your buyer's plan? Because that's what their sellers want to know. I mean, if you have a listing, that's what you have to tell your sellers. Hey, looks like a good offer, but it's not that much down, or they don't have that much money verified. What's the plan if the appraisal comes in low?
Well, in fact, here's the deal. I have a teammate of mine who I represented a buyer actually from YouTube here. I handed it off to him. It was a VA buyer, and they bought at 100% financing. But part of the deal was that they said that they were willing to pay $10,000, above whatever it appraised, because they didn't think it would appraise at the purchase price, but they would cover the $10,000 gap. That deal just closed. So the appraisal came in less than the purchase price. The client was willing to pay the $10,000 gap in order to cover that. This was a VA loan. This was a multiple offer situation against other offers, and it was a VA buyer that got approved, and it closed. Buyer super happy. All is good. So just because you're VA doesn't mean it can't happen. It's going to be a little bit tougher. There were a lot of offers written for that buyer, but they eventually got a house they loved, and things worked out. But keep in mind too, if you're a VA buyer, not all VA buyers buying at 100% financing. I mean, the idea here, or unfortunately, the misconception is that a VA buyer buying at 100% financing doesn't have any money in the bank, and that's why they're buying using 100% financing. That's not true. If I were a veteran and I had money in the bank, I would still do a VA loan because of how good the interest rate is, how good the terms are in most cases. And so if you are a veteran and you're doing a zero down loan and you have money in the bank, tell that to your client, to your real estate agent, so they can convey that to the listing agent side, and they can say, hey, listen, the client's a veteran. They're purchasing using a VA loan because they're able to do so. It's one of the benefits for them serving for our country. They have money in the bank. They could do another type of loan if they wanted to do it, but they're choosing not to because of the terms offered here. And then the lender can get on the phone and say, hey, listen, VA is probably one of the most flexible loans out there with regards to qualifying income, debt to income ratios, so on and so forth. And it's about having that lender on the other side that knows VA and can let the listing agent know. So it's a communication thing. Yes, it's difficult, but I don't think anybody would say, I don't want to help a veteran if they were in a position to do so. So if you have two offers that are similar, then, go out of your, way, if you're an agent, to help that veteran get it. And if you're a lender, make sure you're checking all the boxes, if you will. I mean, I could talk about this in nonstop, just because it's something that I see in this market that it's almost frowned upon if you have an FHA or VA loan, and it shouldn't be. It's silly. But understand also, if you are a VA loan and you're going up against somebody that's got 50% down, you got to understand, if you have to put yourself in the shoes of the seller, right?
And
I tell buyers all the time. Yeah, go
Jeb,
ahead.
that was what I'm going to say about the VA client that you were talking about from the show here. We did that loan for Christo. And the important thing to remember is he was also buying in a heavily first-time buyer area. So he
Right.
was fortunate enough on that property to not come up against a bunch of big down payment offers. There were multiple offers on that property. Billy did a great job of presenting it as strongly as possible. They did come in strong and say they would be willing and able to make up a portion of the shortage on that. And as a result, among other FHA and VA offers, his ability to make up some shortage on it got him that property. But it's almost like exactly what we're talking about. We had to talk to the listing agent and explain his qualifications. Billy had to structure the offer and the transaction in a way that made them comfortable that this was their best bet. That's what it comes down to. So the appraisal did come in short. It came in shorter than the amount that he was at.
30,000.
30,000.
Yeah.
And the sellers made a decision that with the buyers I had on the table, this is likely, we went through, we looked at every comp in that neighborhood, nothing supported the value, which is what really sucks for the seller, because there were plenty of buyers saying, I am comfortable paying that. So the market had spoken and said, this is the value of the home. Appraisers said, I have no closed sales that support that. This is the highest we can bring it in. The sellers, faced with all of that information, their agent represented them well. We did everything we could on this end. They got $10,000 over the appraised value, which still left them $20,000 short of what the market had told them the home was worth.
There you go. I'm going to follow up here with another question from Marie, because I think it's something that people want to know. If a home doesn't appraise, should you cover the deficit? That's something as a buyer, you have to decide whether or not that deficit makes sense to you. And also understand, looking at the market that you're in, if it's a deficit that is a small percentage, and your market's moving at 1%, 2%, 3% up in appreciation every month, you got to say, is the cost to pay that difference worth it versus waiting and paying a higher price for the next property anyway? And that's part of the negotiation here, and a part of having a good real estate agent on your side, and to help you make that decision. Now, they shouldn't be telling you what to do. They should be guiding you and letting you make the decision. But ultimately, it comes down to what you're comfortable with. If it's a big disparity in what we think the property's worth versus where the appraisal came in, maybe you don't. But if we think that it's a reasonable appraisal, and it's close to what we thought it was worth to begin with, then it might be worth paying that deficit, and deciding on how long you want to wait before the next one comes up. And are you willing to pay more if prices do continue to appreciate?
And Jeb, whenever I get asked this question, I like to reframe it, because buyers and sellers both, they have a different view on this. But buyers look at it and say, well, I don't want to overpay for the house. It only appraised for this much. An appraisal does not determine the value of the home. It is for the purpose of the lender. If you weren't getting a loan, you don't need an appraisal. You need the appraisal so that the lender is confident that they have adequate collateral for the loan. The market has spoken in all of these situations. If there were 20 offers on the home and yours was selected, you may have been the highest, but that was an open and active bidding situation. It essentially was an auction. The market, all of the potential buyers in the market have spoken and said, this is what the home is worth. An appraiser coming in and saying, based off of the recent comparable sales, I don't have any other sales that support that, doesn't change the fact that that's what the home is worth. So we shouldn't sit here and go, oh, hey, the home isn't worth it, should I make that up? It doesn't mean that you should do it, because it largely comes down to, do you have the money, and are you comfortable parting with that money to purchase that home? You may not be, and so it may still be a reasonable decision to back out and wait until you find one that appraises for what you've agreed to pay. But long story short, you're not overpaying for the home because the appraisal came in short. We're in a rapidly appreciating market where there quite often are not enough comparable sales recent and in the neighborhood within close enough proximity to the home to support the purchase price. But the market has already spoken and said what the value of the home is.
All right. So Jennifer did a $2 super chat just to tell me that she muted 2 people. So appreciate that. Is it $1 for every person you mute? That would be awesome. There's
she should start charging us for doing
I know
that.
There's 296 people now. If you muted them all, we'd make $300. Anyway, I wouldn't want that, because then it would just be Josh and I talking. It would be bad. So a couple questions here. Cody is asking, is NACA mortgage any good? So here's the thing. I've done a video on NACA, however you want to pronounce it. Go back, read the comments from that video. Search, look at my channel, search NACA, look at the comments, read those. But here's what I would say really quick. If you can get approved for one and actually get the mortgage, it's great. But the downside is actually getting the mortgage to happen. There's a lot of hoops to jump through. There's a lot that goes into it. It's not something that you're going to get in 30 days. This is months and months of
Longer.
Dealing with things in order to get there. So just depending on your time frame, what you're willing to go through in order to do it, you have to make that decision. But the gold in that video that I did is not the content that I produced. It's in the comments that people wrote, because you get people saying the good of it and the bad of it, and you can read into read in the lines yourself and make your own decision there. Renee Kwango, looking to buy, basically asking, are condos better than single family homes? I think there's pros and cons, right? Some people, don't want single family homes because there's maintenance involved, because, there's cost involved with maintaining that property. Just there's a lot going on. And then you could say the other side, people don't want condos because somebody's telling them what to do. They're usually smaller, don't have yards. So there's pros and cons to both. I don't know that one is better than the other. It's what's better for your situation. Josh, anything you want to add to that? I mean, I've done a video where I've talked about the pros and cons of this. And it basically comes down to maintenance cost and that sort of thing. I mean, condos are going to appreciate less than single family homes in most markets. So you've got that factor thrown in there as well. But anything you want to add to that, Josh?
Yeah, we went through this question probably a month or two ago, and the thing that I said at that time is I own two properties that are in homeowner associations that are technically condos. There's pros and cons. Both of them are good. I wouldn't say I don't like those properties. There's restrictions, but you get things with those restrictions. Looking at it with the loan officer hat on, and from that perspective, with interest rates as low as they are right now, you pay about $5 per thousand of mortgage borrowed. So if you're looking at a $300 a month HOA, that's $60,000 of purchasing power you could be losing. So when we last had a market where condos got really popular because they were more affordable relative to homes, HOA dues were more like 170, 180,
Right.
$200, and rates were 5.5%, 6%, where you're talking $7 or $8 per thousand. So maybe you were losing $25,000 or $30,000 of purchasing power going down to a condo and taking on those HOA dues. So the numbers don't make them as relatively attractive to single family homes as what we've had in the past. But at the end of the day, all you do is, we've talked about this before, numbers never lie. Run the numbers. What are the homes you can afford? What is that payment minus with no HOA payment look like? And then what does the condo look like? And decide what you're getting and what you're looking at. Because for the most part, if you want a similar payment, you're going to get a lesser home, a smaller home. Maybe it's further out. Maybe it's not on as big of a lot or in as desirable of a neighborhood relative to what you can get in a condo or a property with an HOA.
All right. Good explanation there. And that's going to kind of take me into this question here too, that Roxy had in San Bernardino, asking, would you recommend saving or jumping in the market? And what I would say is the numbers never lie, right? Run the numbers. Can you qualify for a house that you would like now? If the answer is yes, you feel comfortable with that, you're not stretching yourself, I think now is as good a time to buy as any, because I do believe that prices are going to continue going up. Now, what I will say with that is that, people are moving out of, areas like Orange County, or not necessarily moving out of them, but considering areas outside of Orange County, San Bernardino, Riverside, some of these areas, because they're more affordable. They're less expensive than say Orange County and parts of LA County. And so you've got this migration of people leaving to go out there. If for whatever reason the market changes at all, the first areas that are going to get hit first are the Riversides, the San Bernadinos, because that they're the last in, first out. So just it's tough to say. I don't think prices are going to go anywhere anytime soon. So I think if you can qualify, you're not stretching yourself, you can do it now. I think that's the best opportunity. But Yeah, it's obviously a decision that you have to make. But we've talked about it too, Josh, about saving, and you can get into that too.
I wish I was in the office right now, and I would have to do a little searching through my Google Drive. But
That's not your office.
It's not my office, bro. I had a
Those are lovely
presentation.
paintings.
They are, aren't they?
You.
That's why I put them back there. I had a presentation from 2003, 2004, and I had some awesome data from First American Research that did a Southern California heat map from 1980 through that time, 2002, 2003, and you could watch the cycles where it would heat it. The home prices would heat up along the coast, and then they would get further inland, and then they would get all the way inland, and then you would watch as the market starts cooling, it cools inland, and then it cools in the middle of Orange and LA County, and it gets all the way to the coast, and those prices cool. We saw like 3 cycles of it, and you could just see visually that's what happens. So the second piece of that is, how quickly can you save? Are you living at home with your parents rent free and saving a couple $1,000s a month where you could save $25,000 in the next year? If we look at a median home, LA and San Bernardino County, if we're talking a first time entry level home, you're still talking $500,000 to $600,000. A $500,000 home at 3% appreciation is going to go up $15,000 in the next year. We've been appreciating much faster than that, but say 3%, $15,000. Can you save $15,000 in the next 12 months? And at the same time, on that $500,000 with a FHA mortgage, you would pay down $13,000, $14,000 of principal. So you would have $28,000 to $30,000 of accumulated wealth that you would pass over while you're trying to save to buy into a home. So don't see anything happening here on the horizon that would cause home values to level out or not appreciate. And as a result, it's going to be really hard to save and keep pace to put yourself in a better situation in terms of what you could do right now.
All right. Great explanation there, Josh. Omar, I skipped this question earlier. Sorry, not on purpose. I meant to come back to it, but would you recommend a third-party inspection on a brand new home? So, typically brand new homes come with some sort of warranty, 10-year warranty here in the state of California. At least that's what they were for a long time. I think that's still the case. But yes, I would recommend getting a third-party inspection. It's a couple $100. Here in California, $350 to get a third-party inspection. Why? Because, builders, they build these homes quickly, right? I mean, they go up quick. The goal is to get through them, move on to the next one. And if there was something wrong, and you found it later on, you might be able to get the builder to come back and deal with it or what have you. But I think it's worth knowing going into it because, you can get them to do this stuff on the final walkthrough, and knowing that there are problems that need to be addressed sooner rather than later, I think is a good thing. So the answer is yeah. Get an inspection to come in there. The property's vacant. It'll be quick, they'll check the electrical, they'll check the plumbing, they'll check all the main systems of the house to make sure they're working properly. And if they're not, you can tell the builder, hey, listen, I'm not closing on this property until these things are fixed, and they will make those adjustments. And there's a chance, that everything's perfect. But what I will tell you is a home inspector can walk through a house that was built 40 years ago and find items that need to be addressed. And they can also walk through a brand new construction property, which I did it myself in 2006. There were multiple things wrong with the property that need to be addressed. And these are things that I might not have found out until later down the road because, maybe they weren't in a room that I would have put certain things in or what have you. So, just keep that in mind. I would consider doing it if the cost makes sense. All right. We got,
I got a good one if you don't have one jumping out at you.
Yeah, I'll go for it.
So San Nissan, that scares me. Those are some crazy eyes in that picture. It's like kryptonite man or kryptonite woman there. But anyways, hi Jeb. Why do you need to be cross-qualified? Our lender sent an email that he was reached out for that. So this is one of the biggest areas of misconception. Why does the seller or their agent want this? What does it mean? What do I have to do? So why don't you go through why, as a listing agent, you would want a cross qualification, and then I'll go through what we do and how we make it as easy on the other side as possible.
Yeah. So as a listing agent, when I'm representing a seller of a property, I want to verify that the people making the offers are actually qualified, and because I have a background in lending, I can look at the contract, look at the documentation that they provided, typically ask the right questions, and I don't really need cross qualifications. It's something I never really require, in most cases, it's like 1 out of 50. Maybe I'll say, Josh, can you look at this? Because I'm able to do it myself and have the right conversations. But the majority of agents out there, listing agents, aren't in the position where they can even understand this information. And sometimes when you have loans like FHA loans and loans with less down payments. And a lot of times, in this market, people will send you the DU findings, the automated underwriting findings, along with the contract. And while those can be manipulated very easily, oftentimes I take it at face value that this is the information on there. And if I look at it and the ratios seem to be really high for whatever reason or whatever, it could be a red flag. And unfortunately, the information on that stuff is only as good as the person that input it, right? So if they put incorrect information in initially, it's going to spit out incorrect information, incorrect findings at the end, and possibly tell me that somebody could be approved when in fact they couldn't be. And so it's a good thing if you're in that situation to say, you know what? Instead of wasting my time, my seller's time by going into contract with a buyer that may not qualify because of whatever, I'm just going to have them cross qualify with my lender. And that would be Josh in this case, just to verify that that information is accurate. It's really common in this market. Is it a pain in the ass? In some cases, yes, depending on who's on the other side. Some people can be really difficult and say, I actually have to speak to the borrower and deal with all that. Not necessary, but in the cases where I'm representing a buyer and I come across that and Josh is the one that is doing the loan for them, I say, hey, Josh, here, listen, that lender is asking for this information. Can you reach out to him and provide him with everything he needs or she needs in order to see that these people are qualified? And then Josh and that lender on the other side are communicating back and forth, and the client's never involved. So you're not really having to do the legwork. It's your lender and their lender, if you will, having that conversation. So I know it's a pain. Is it necessary? In some cases, yes, depending on the type of loan. It's one of those backstops, if you will, just to make sure you're not getting in contract with somebody that doesn't truly qualify. But Josh, you mentioned what you're doing in order to facilitate that.
Yeah, absolutely. So say you have an offer accepted pending a cross qual. What we're going to do is say, cool, who is the lender that we're cross qualifying with? What I will do is send them an email. This is what I include in the cross qualification package. Is there anything else that you would like to see? 9 times out of 10, they go, nope, that's awesome. So we make a secure link in our box.com account with all of the info they need to see. We send it over to them. They open it up, and usually in about 10, 15 minutes, look through it. Boom, you guys are good. If they have any questions, maybe they go, hey, I wasn't clear on this, or that looks a little bit dicey, or hey, your DTI is high, are you okay? Or hey, this looks pretty tight on cash to close. Do you have everything there? It rarely comes up that we have such a tight buyer, because generally what I would say is at that point, say, hey, Joe, I just sent it over. Can we jump on a call? I have some things I want to walk you through. Now, on the flip side, if Jeb says, hey, I got a listing and I got a dicey file here and I want to make sure they qualify, I'm going to reach out to that agent again. I'm going to send them my cover sheet that says, please send me all of these items and securely upload them to our website or any other secure method you have of getting us the borrower documentation. And you would be stunned and amazed how many times dicey borrowers have dicey loan officers who can't follow instructions, can't get the right information over. And it's just a big, long back and forth process trying to get what we need just to confirm. So for me, that's just a service to Jeb or any other realtor that I work with. I'm not trying to sell that person. I'm not trying to steal the loan. We're just trying to confirm for our realtor that they and their sellers have a solid transaction put together. So Jeb, the other thing that you said, you are unique in that you're pretty comfortable with DU findings and knowing what they mean. I would say for every one cross qual I do, I get 3 or 4 requests to say, hey, will you look through these DU findings and tell me what you think? And they're interesting. Like the things that I look for, it truly is garbage in, garbage out. People think, hey, I have an automated approval. There's actually a loan officer in Orange County that blasts every realtor within 300 miles that you have to get a DU approval, that DU is an automated underwriting. You have to have it. And we do these in 30 minutes or less, anytime you want. DU, automated underwriting, it's garbage in, garbage out. So what are we looking for? We're looking for telltale signs of garbage in. If we look and every borrower has an exact round amount a month of monthly income, everyone $3,000, $5,000, does it happen? Do we have people with perfectly round salaries? Yeah, but not very often. Same thing with assets. If every business account has 17 or every bank account has $17,000 in it, if you look and there's 14 different accounts omitted from the credit report and not counted in that analysis, you just start looking and going, you know what, there's some things here that don't look right. And in that situation, we may just call Jeb back and say, you know what, I don't like this one. I'd like to do a full cross qual and see everything here. And generally, when we see the full cross qual, it falls apart. Like, you guys would be amazed at how many times we do that cross qual and have to start asking questions and picking at it. And those people would just, you know what, we're going to go offer on another property. It's happened 2 or 3 times in the last 5 years where there's just giant questions and you start asking the questions. I mean, I literally had one like 3 years ago that the lender didn't know how to qualify the borrower. They had rental properties. They didn't know how a rental property is treated. And when you asked her about it, she's like, no, I did it the right way. I go, well, okay, I'm not going to argue with you here and I'm not here to teach you. Can you please go to one of your underwriters and get that clarified? Sure enough, the next day they go, you know what, they've decided they don't want this property.
Imagine that.
Imagine that.
All right, guys. If you're watching right now, you haven't already, ask a favor, right? We don't ask for a lot here, but if you're watching, hit the like button, help us share the content. We put in, 2 hours every Wednesday to help you guys and guide you through the process. And it's all we ask is that you hit the like button and share it with anybody that you know that might be looking. All right. I got a good question here, Josh, for you. Sebastian Fitzgerald says, can you take out a second mortgage for the appraisal difference? In Kansas City, appraisal is way lower. I'm assuming Kansas City, KC, is way lower than the sales price, like 40 to 50 grand. So if I'm buying a house, it's not coming through, can I get a loan for that appraisal difference, Josh?
So the lender on the second mortgage is going to want an appraisal for the same reason as the lender on the first, to make sure that there is good security and good collateral for their loan. So if the first appraisal came in low, unless they do an appraisal and it comes in higher, they're not going to make that loan. And if we're talking about additional funds on a short appraisal, you're up close to 100% financing. There are a couple of crazy lenders doing seconds to 100%, but the terms are really egregious and reserved for the absolute best qualified borrowers. So answer to that most likely is going to be no.
All right. Let's see.
I got one, my friend.
Hold on. I cut you off. Sorry. I hit it about the same time you did. In La Jolla, luxury homes are not moving. Lots of inventory, lots of days on the market. Are you seeing the same in Newport Beach? If so, do you have a theory why? I'm not. I don't sell a lot of property in Newport Beach. I sell properties in all price points. What my average price point is probably around $1 million, but I sell properties in the 3 million range. But properties in that price range are still moving here locally. I think it depends on the price that you're looking at purchasing, right? I mean, what you have to consider is that as you start to move up in price, that luxury level, there's just less buyers. Typically, right? You got less people that can afford those properties. And generally speaking, those people make less emotional decisions, right? So they are more logical thinkers. And so they're not quick, a property comes on the market. In some cases, they don't make an offer the first day. It takes them a couple times of seeing the property. Maybe it sits on the market a little bit. They analyze it or what have you. So it's hard to say why a property might be sitting on the market. Now, if every luxury home in the market wasn't selling, then maybe there's something more going on. But I don't know that that's the case. And that's certainly not the case in Newport. Homes are still selling very quickly. And we're talking multi-million, like super luxury, $20-30 million properties are still selling. And some with multiple offers. I have a couple friends in that space and talk to them often about what's happening and things are moving. So I wouldn't overanalyze it at this point. You just, it depends on, why things, is everything sitting or is it just a couple here and there, and at what price point, right? The higher stuff is going to sit longer, no question. Anything you want to add to that, Josh?
No, I would just say if you look, we see these every couple of years in Orange County. You'll say, hey, home sales sets new Orange County record, and you look at it, and it's almost always had a 30 or $40 million price reduction. In those price ranges, they put very aspirational listing prices on them, saying this is the finest home that's ever sold in Orange County. We want $100 million, and then eventually it sells for $60 million, which those numbers are almost incomprehensible to us, but it's a very, very different market. When we're sitting here talking days on market, it's not. It's rare that you put a $50 million or a $10 million or a $20 million property on the market and they sell immediately. It just takes a little longer for that buyer to come along.
No, absolutely. I mean, I was talking to somebody yesterday, and we were talking about property and what have you. And I looked, and there was a $69 million one in Newport Beach that just came on the market. It's been on the market 26 days, and why hasn't it sold? The average days on the market are 7 days. It's 70 million. Now, that's not really the conversation, but I mean, it just shows you. I mean, there's really, really expensive homes that are on the market. And it takes a special buyer once you start talking about numbers at those prices.
Jeb, the important question is, did you need me to get you pre-approved so you can get your offer in on that house that you're looking at for $69 million?
It's not really my style.
No.
I looked at it. Location's great. Nice pool, nice view. House, not so much.
All right.
Yeah, we'd have to basically tear it down and start over. Yeah, it looks like a Tuscan villa. Which I think every house at that price point looks like a Tuscan villa, to be completely honest, unless maybe you're in South Beach and there's like some contemporary flair in LA, but in Newport, they all seem to be like that. If you guys are watching right now, are you getting any delay on YouTube at all? Obviously I have it running on another screen here. And so I don't know if it's just my feed or if it's another feed going on. So, that didn't make any sense. I don't know if it's my internet connection or yours.
I've seen you freeze up a time or two, but just for a second or so, and I haven't seen anything other than that on this end.
All right, so
hold on, bro. You already knocked me out of line. I had one.
All right, here we go.
So Lakeisha, another regular listener, a regular viewer, does the buyer have to pay for the appraisal if the buyer changes their mind to purchase the home at closing? So this is a good question. People always like to ask. When we open a loan, we most of the time will send out a credit card authorization because the appraiser requires payment prior to going out and doing the inspection. They're the only person in the transaction other than your home inspector that gets paid before the deal closes. So with that, they are paid before they go out and do the inspection. And if the deal doesn't close, that's the cost of doing business, especially if you changed your mind. You essentially, the appraisal was ordered for the benefit of the buyer and no one else. So that cost falls on you if you change your mind and decide to back out. Now, that being said, in the interest of time for us as a lender, we have to have signed disclosures from you before we are able to charge you anything, including an appraisal. So 9 times out of 10, we order them on our credit card as soon as we have a fully executed contract so that we don't lose any time, especially in the current market where appraisals are taking an extra long amount of time. So in that instance, if something falls apart, as long as we're still working together and we're going to get another deal put together, I don't want you to get stuck with that any more than you want to get stuck with that. So we'll eat an appraisal or two a year, unless it just comes down to, hey, you know what, that paint carpet in the living room, I just didn't like it. We're going to go buy another property. But if something happens and the deal falls apart and we're still working together and do a loan, we'll eat the cost on that one.
All right, here you go. Mr. D-Man has a question. Jennifer Lego wanted to hear the answer to this. I'm hearing that lenders are having trouble meeting contract closing dates due to high volumes. Are you seeing that at all? Is that true?
I would be stunned just because last year volumes were much, much higher with all of the refinance business on top of purchase business. And for the most part, we haven't seen a lot of layoffs yet. So most lenders are overstaffed relative to the volume of loans that they're working with. So loan volume is still high. This is still a very good year for the mortgage business, but staffing is also really high. So I haven't seen it with any of our lenders. I've not seen extended turn times. I haven't heard of it with any of our competitors. It's always nice if you hear that your competitors are having a hard time meeting closing dates, and just haven't heard it or seen it recently.
All right. Jennifer did say that it was having some trouble with the internet there for like the last 7 minutes. I'm doing a speed test here in the office, and we are very fast. So it is not the
and compare all three of them, and compare three things: expertise, knowledge, willingness to help, and ability to help, and then what those numbers look like. I would be stunned if a local expert, either a broker or an independent mortgage bank, isn't going to get you better terms and give you a much better feeling just in terms of knowledge and expertise.
All right, good stuff. Let's see here. I've got some. I had a good question and I lost it, and now I don't know where it is. I just saw one. Somebody asked about buyer's remorse, and I actually have one here. I saw it. I'm going to try to click on it.
You have buyer's remorse?
I don't. I bought my house in 2012, man. I'm feeling pretty good. Let's see here. I saw a question about buyer's remorse. I can't find oh, here we go. Any stories of buyer's remorse or too early for that? So clearly there's a lot of stories on it, but I've got one of a client that I'm actually going to meet with on Friday. He's not a client yet, but possibly a client from YouTube.
To sell his home?
To sell his home. He bought it in February. Absolutely hates it. He moved a little bit outside of Orange County, and it's too hot, way too hot. And he's like, I can't do this. I got to be closer to the beach. So he's going to sell the property and buy something in Orange County. Now here's the catch. He paid, I can't remember the numbers. It was like $530 for the property. Put 20 grand into it, and comps on that property are like 625. So it's gone up like 12% or something since he bought that property. So he's still going to be able to sell, cover his cost, and buy something else. So there are people that are going to have buyer's remorse. Absolutely. It's hard to say how many or, in what areas or what have you, but yeah, you're going to see some of that. People, wanting to buy something and getting in quickly, and, especially with waiving home inspections and doing some of these things that I've seen, you're going to have more of that, and people moving to areas that they never considered before because they're like, you know what, I can buy a house a lot less expensive there. Let's move to Texas. Let's go to Texas. It's a lot less expensive there. And then they get there and they're like, what in the hell is this place? It's hot. There's bugs. The taxes are crazy, property taxes, whatever. And they're like, I had no idea. And it's, people are not thinking through this stuff, but it's definitely going to happen. Just, who's to say how much and when. All right. I
got one here, Jeb.
All right, let's hear it.
Lynn with a nice short one. Should I wait to refinance? And this one falls back under the broad heading of numbers never lie.
Well, let's talk about rates here, Josh. Just go into rates too, and just cover what's going on, and maybe insight for the next month or two.
Absolutely. So we had ADP jobs report came out today, and we have the more important Bureau of Labor Statistics figures for last month coming out on Friday. We talk a lot about technical analysis. We pull up the candlestick charts and look at them here. So we are right on resistance, and I expect nothing to happen tomorrow because we have no news, and the market is looking, going, what happens with that jobs report on Friday? If we have a blockbuster jobs report and there were 1 million new jobs created, rates are probably going to get worse, and that resistance is going to hold. If we have a bad to very bad jobs report where people are disappointed that less jobs were created, less people went back to work, we could push through that resistance. And when we look at the bigger term technicals, I expect at some point we're going to. So it's a tough call. We locked a couple loans today. I would love to think we're going to push through to better rates, but it could go either way. Either that resistance is going to get hold and we're going to go back to the other end of the range. So the good news is we're in an interest rate range. For the most part, your best qualified borrowers on conventional loans are still under 3% with 0 points and 0 lender fees. Your FHA and VA borrowers, the best qualified, are in that 2.25% to 2.5% range. Once you get to the 2.5% to 2.75%, you're getting a nice rebate to cover closing costs. So rates are spectacular. Are they at the best levels that we reached in January? No, we're a little bit above that. But it does appear as though the market wants to move a little bit better. So I wouldn't expect that we would tell a massively different story next week. Even if we broke through that level of resistance, maybe we're an 1/8 to 1/4% better in interest rate would be our absolute best case scenario. So with that, and relating back here to Lynn's question, should I wait to refinance? Rates are really, really good. pretty much at the best levels ever, other than 2-3 weeks towards the end of the year and the first part of January. So numbers never lie. You need to get with a loan officer that can do an analysis for you and say, here's what your current loan is, here's what is available in the market, and if it makes sense to do it now, I would say absolutely do it now, and most likely at a low or no cost. Don't pay any points, possibly do a no cost loan if you have a loan size that allows it. And then if rates do move lower later this year, 2 years from now, 3 years from now, you can still benefit from rolling that interest rate down again later on. The risk in waiting is saying, hey, I know or I think rates are going to get lower going forward, and they don't, and they go higher, and you miss the opportunity whatsoever. So if the numbers make sense to refinance now, and it's just not true just for Inland, it's true for anyone. If you think you might want to refinance, that rates might justify doing a new loan, have someone do an analysis for you. Here's your current loan, here's what's available in the market, and the numbers will tell you whether it makes sense. And if it doesn't make sense right now, they can put you on a watch list, and you'll get triggered and they'll get triggered when the rates do get where they need to be.
All right. Witcher Works has a question here, Josh, that goes with the numbers never lie idea. Does it make more sense to put a higher down payment or only do what is necessary for the loan and hold the cash if your goal is retirement? So I know you've talked about, potentially, putting the least amount of money down to what you're comfortable and having cash on hand because, cash is king. And using the bank to leverage yourself a little bit just because of where interest rates are. Those aren't your words verbatim, but close to it. So what are your thoughts on somebody putting less money down or more money down based on that scenario?
The cost of money right now is plus or minus 3%. The first $750,000 of that on a primary residence or combined with the primary and second home is tax deductible. So your actual cost of that money is somewhere 2 to 2.5%, depending on your tax bracket. So for most people saving for retirement and investing, I would think you have a comfort level that you can get somewhere 4%, 6%, 8%. So with that being said, as long as you can qualify for the home that you want, the price range you need to be in to get a home that you're comfortable with, get as big a loan as you are comfortable with. So a lot of times what that means is it's a 20% down. What's magical about 20%? We get rid of mortgage insurance. So it's kind of a balance of not putting 35 or 40% down, keeping that extra money working for you, but making sure you're not paying any more for the mortgage than necessary by eliminating mortgage insurance. Sometimes we have people that'll say, I got 5% down, I got 10%, but I'm thinking maybe I should just do 5%. And you run the numbers and they're shocked at how little difference, even on a $500,000 house. We ran through the numbers earlier. $500,000 house, 5% down is $25,000, 10% is $50,000. So we got $25,000 difference. That $25,000 saves you about $5 per thousand. So it'd be $125 difference a month. So the thing I always like to ask people is, what do you value more? $25,000 liquid available to you to invest and grow more, or do you value $125 lower monthly payment? And it's not 100%. It's not an obvious answer to that. 8 or 9 out of 10 people say, I'd rather have the $25,000. 1 or 2 of them are going to be like, no, I'd rather have that lower payment. Or they might have to have the lower payment to qualify for the mortgage. So those are the 2 things that we want to look at. So it just comes down to do the analysis, look at the different options of minimum down to maximum down and somewhere in between that you might consider, and find the one that speaks most to you and your comfort level.
All right. I like that advice. Let's see here. What I would also say to that though, before we move on to the next question is, you're also going to have to get a seller to accept your offer, right? So if you're in a market where you've got it's competitive, you've got multiple offer situations, the more money you put down in a lot of ways might help your offer stand out, right? I mean, what I've found in representing sellers for a very long time and also being on the buying side and helping buyers is that sellers often look at price first, down payment second. And people say, well, why does the seller care how much down payment I have if I've been approved? Just something they look at. It gives them more comfort in knowing that you have a larger down payment. Now, a good agent can help mitigate or minimize how much they rely or care about that down payment because they can explain what all of that means. But what I'll tell you is, if you're in an environment where it is competitive, you might have to put more money down in order to help your offer stand out. So keep that in mind. So when you're talking to your agent, and you're talking about down payments, I would say 20% down. If you were considering between 20 and 35, then, not a big deal. I think if you got 20% down, you're pretty good. But if you were going, hey, I'm thinking about 20% down, or maybe doing, 5% down, there's a big difference there. And there's a big difference in how sellers are going to look at those offers. I mean, whether you agree with it or not, it's the reality. So just take that into consideration, and talk to your lender, talk to your real estate professional, and they can help you make a good decision there. Radiant Kratos, also a regular viewer on here, has a question about our crystal ball. Josh, I'm not sure if it's come out of the repair shop at the moment, but we're going to ask, how long do you think until you actually meet a 6-month supply for a balanced market?
That's a good question, and it's a tough one to answer.
Well, if you look at the St. Louis Fed numbers, it might be later this month.
next week,
Yeah.
Couple weeks from now.
But if you're looking at unsold inventory levels, obviously it's something we don't know, right? I mean, it's too difficult to answer that question. But what I will say is that, if we're 2.5 months right now, which is the number that I gave you earlier from the National Association of Realtors, if that number doubled, so the number of homes, and I think it was 1.23 million homes on the market, active homes is the number that I said, or somewhere close to that number. That means you would need 2.46 million homes on the market in order to reach 5-month supply. So still not even 6-month supply. So if the available inventory doubled, you still wouldn't be at a 6-month supply. And so, Josh mentioned earlier, real estate's local, right? Well, you might have a 6-month supply in your city. You might not have it here where I'm located, right? It might be much less, or you might be in a county in California. I think there were 2 that haven't appreciated year over year or month over month. I forget exactly the stats there, but inventory in those areas are higher. Well, that's not for the entire state of California. It's just those counties, and those counties are having inventory added to the market. So it's all local. It's hard to say. I mean, we haven't been at a 6-month supply of inventory, and I don't know, Josh, do you know the stat on that?
No, I don't have it in front of me. It's been a long time.
Since probably prior to 2012, I would think. I mean, it's been a long time. 6 months? Yeah. Anyway, yeah. Anyway, so do you want to answer that any further than you have, or should we move on?
No, it's good. It's just a really hard question to answer. I wouldn't expect it to be soon. I would love that we would get somewhere in that 4, 5, 6-month range sooner rather than later. The supply and demand is going to make it difficult. But what I would say, can we expect demand to decrease a little bit as prices are higher and less people can either afford or are comfortable to buy? Yeah, so demand could wane a little bit and supply could definitely increase. I don't think it's going to double. So really, it's going to be tough to get to 6 months, but hopefully we get to 4 or 5 months that's close to a balanced market.
All right. Question here from Hollisan Santos. Live in the Bay Area, had a lot of challenges with Quicken Loans. Some sellers are not even accepting it. Do you guys have any comments about that? So I don't know, Josh, do you have any comments? I mean, I've been on the other side of buyers having Quicken Loans and had fine escrows. They've gone fine, but keep in mind, if it's with one of these Quicken, I'm trying to have a conversation with the person on the other side. If I'm the listing agent, to make sure they are qualified, even if I'm the buyer's agent in that case, making sure these people are qualified. Quicken's not necessarily bad if you've got a super gold-plated loan. It's probably going to be a pretty straightforward process for the most part. But in a competitive environment like this, they're not mortgage professionals in most cases, and so having a person that's knowledgeable, knows how to work with a listing agent, knows how to work with a buyer's agent, probably not your strongest selection of mortgage professionals out there. So, that's one of the issues in this environment is you really need to have somebody that can have those conversations, that can explain information. And my guess is you're not going to find that for the most part. Josh, anything you want to add there? I know this can.
No, you got it pretty straightforward. If the loan is easy enough, they'll be able to do it because you're dealing with a kid in a call center in Detroit. I believe they have a call center in Cleveland as well. So in case you were not aware, home prices are a little different in Cleveland and Detroit than they are in the Bay Area. So you have someone 12 states away with no understanding of what your market looks like, who's done loans for a very short period of time. If you look at your pre-approval letter, you will find your mortgage professional, and I use the term loosely, your mortgage professional's NMLS number, and you'll see how long they've been in the mortgage business. And you'll also see a 10-year self-reported employment history that will likely include pizza delivery, 24-hour fitness, personal training, and or GNC jobs. And you think I kid, but I would almost guarantee you one of those will show up in there. So if you have an easy loan and you're willing to deal with an inexperienced loan officer, what do you get in return for that besides lots of television ads and a pretty app? You get very average to poor terms for that in terms of higher closing costs and a higher interest rate. So for all of that, I would get with a local expert. Someone asked earlier, do I go with a big bank? Do I go with an internet lender? I don't think you should go with an internet lender. You can try with the big bank. I know in the Bay Area, the big banks on super jumbo loans are really aggressive on that stuff. So make your calls. The biggest issue that I have is people that just call Quicken and don't talk to anyone else. They have no point of reference, no point of comparison. Call a local expert from an independent mortgage bank. Call your bank. Compare terms, compare knowledge and expertise. The kid in the call center is not going to be your choice once you get to the end of that.
And I will follow up with this is if you need one of those people, it doesn't matter where you're watching right now in the United States. Josh and I are located in Southern California, but you can be anywhere in the United States. It doesn't matter. Reach out to us if you need a mortgage professional. We'll put you in touch with someone. The same thing with real estate, right? If you need a professional, we both network. That's what makes us different, partly amongst a number of other things, but we're constantly trying to improve, constantly trying to be the best at our jobs. And so we're constantly networking with, and I use the term networking loosely because you're not networking per se. You're just out there having good conversations with people about what's happening in their markets. And we know people all across the United States. We've both been doing this. I mean, Josh longer than I have, 25 plus years, me 18, 19 years going on this year. And we know a lot of people that can guide you in the right direction, that do business the same way we do. So our contact information will come up at the end. It's in the description if you want it, but reach out. We're happy to put you in touch with people that can.
Jeb, let me just close the loop on that one with a story here. We had to do a cross qual with a Quicken client. Quicken refuses to do cross quals. They say we have $1,000 guarantee to the seller on our pre-approval letter. My seller was not okay with that. So the buyers were super cool. They called and did the cross qual. I'm not going to name any names here because their agent was actually referred to them by Quicken, and Quicken received a referral fee for that agent. The agent said, by all means, check with them, with the seller's lender, because they may be able to get you better terms. We ended up getting them an eighth lower interest rate and $15,000 in closing costs. And in talking to their agent, she says, I get 6 to 8 referrals a year from them and pay them a referral fee. I have problems all of the time. They can handle easy loans, and that's it.
Well, I put a piece of candy in my mouth while you were talking.
You thought I was going to go longer. You thought I was getting on my favorite topic and take 20, 30 minutes.
It's the first thing I've had to eat in like 5 hours, 6 hours. So I'm starting over here. But anyway, Brian has a good question, or not really a good question, but a comment that I think is important, because you guys are often asking, should I sell my house? Should I do this? And the question is always, if you sell, then what? Like, what is your plan, right? Because in this market, you need one, because if you sit on the sidelines too long, you might get priced out. And unfortunately, that sounds like what might have happened to Brian here. Sold his house with the intent to buy a new one as soon as debt dropped off his credit. So he was waiting for credit to get better, maybe qualify for a little bit more, not 100% sure. But this was back in 2020. Prices have gone up considerably since then. So in a position now where going to be paying a lot more for that property. So if you're planning on selling your property, have a plan to do that. If your plan is to sit on the sidelines and wait, that's fine. but just understand the repercussions of what may happen by doing that. I know people that sold in 2019 that are still sitting on the sidelines waiting for home prices to come down. Same can be said back in 2012 when the market turned and prices started going up. People were like, oh no, this is just, prices are definitely going to come back down again. They can't go up yet. And they've been going up and up and up year over year since then. And people got priced out of the market. It does happen, people. I'm not here telling you to buy a house. I'm just saying have a plan, and whatever it is, just be comfortable with it. If prices go up and you didn't buy, you got to be comfortable with it. And if you did buy and prices come down, as long as you're comfortable with the payment, doesn't really matter. But anyway.
And I don't know Brian's story here. It's a little bit of a tangent, but I would also say this is why it's important to work with experts. If Jeb had been working with Brian, he probably would have said, hey, let's talk to Josh and make sure that we need to wait. So I don't know the exact situation here, but we don't need to wait for debt to drop off the credit. If you close today and you get your wire of your seller proceeds tomorrow and you say, I'm paying off 4 credit cards, an auto loan, a student loan, and I want to see my credit skyrocket, we just need proof that those payments are made, and we can do a rapid rescore, and next week we can have a higher credit score for you. That's one of the reasons why I always tell sellers, talk to your lender before you get to that point in the equation, so you know exactly what you qualify for, and make sure you can get what you want once you sell. Jeb can give us a number. Hey, this is what they're going to walk away from. They're going to walk away with $220,000, and they say, well, I want to buy a $900,000 house. Cool, this is what it looks like. Are you comfortable with that payment? Is there anything we need to work on? Because it's a dance in this market that everything has to come together really quickly, and it's important that you're dealing with people that can advise you and help you not get on the wrong side of the market.
Yeah, and Carly put a good comment here. If you're feeling pressured and anxious, consider backing out, right? I mean, you don't have to buy. I mean, some people have to buy a house, but majority of people don't have to buy. So don't get caught up in the hype of it all. Just make sure you have a plan and you stick to it. I was also reading through some comments from back at 6:30. I mean, I realized we're 20 minutes past that. I mean, that's how far back I was, where the stream was delayed. And again, I apologize for that, guys. We'll see how it turns out at the end, but hopefully those 5 or 7 minutes of content that you missed, you can go back and watch it, and it's not screwed up. But we're pushing 7 o'clock, Josh. Anything any final questions here you want to try to answer before we head out?
I didn't have any queued up. Bernardo Martinez asked a question here. In case interest rate increase before I decide to buy, will a higher down payment offset the interest rate? For the most part, no. The bigger benefit or the bigger thing would be pay points to buy the rate down. If you guys have watched, Jeb and I don't propose that you do that. But if you're trying to keep the payment where you want it or need it to be, it's more effective to pay points to buy the rate down than to put a bigger down payment. The downside to it is a bigger down payment. You'll get those funds back when you sell the home. Paying points for an interest rate, you only recoup them to the extent that you have that mortgage long enough to enjoy the lower payment.
We're going to address one more question at least here, because I think it's a good question, and maybe you can add some insight onto it. David Gutley is saying, how do I break up with my real estate agent who is a friend, or the person is a close friend, who doesn't provide helpful guidance? So Josh, how would you approach that? Good friend, not getting what you need out of them in this market.
Wow. Wow. That's hard. It is really hard, because people will accuse me of being mean, but actually inside I'm a big softie. And that one is hard because you want to maintain that friendship and be close to them long term. But we've talked about this. This is one of, if not the biggest financial decisions you're ever going to make. And in this market, it is important to have an expert on your side that's giving you everything they've got. So if you're not getting that helpful guidance, you've made the tough decision that you have to do it. I would just break it down to them, whether it's in a face-to-face conversation or in an email. These are the things that I'm looking for. These are the things that I'm not getting. I spoke with another realtor. We went and looked at some properties. They've done the things for me that I'm looking for. And unfortunately, I'm going to have to go that route. I understand that you're not going to be happy with this. I hope it doesn't impact our friendship.
No, I mean, it is a tough one. I mean, as somebody who does most of my business relationally, past clients, friends, family, sphere of influence, that sort of thing, that's where the majority of my business comes from, 90% or so. When occasionally, I mean, I'll find out a client of mine went out and bought a house or sold a house and didn't call me or whatever. Those things hurt, right? They sting because it's like you felt like you did all the right things. But I'm the kind of agent, I can move past things pretty quickly. I don't hold things, like I don't hold grudges. I'm not that kind of person. Like, yeah, it sucks, but I move on. So I think if you're willing to have that conversation up front and they don't have to find out about it after you've gotten an offer accepted, it's a much better situation. And if they can't accept it, then that's on them, right? You've done your part. You've done what you're supposed to do as a friend. And you've got to do what at the end of the day is what's best for you. And so, have the conversation up front versus letting them find out about it, on the other side. And then, hopefully everyone can move past it and get what they want out of it. So
this isn't directly comparable, but maybe this would help some. We get notified from a lot of our lenders if a client that we've done a loan for orders a payoff demand. And earlier this week, I get an email that says, hey, so-and-so has ordered a payoff demand. So either I need to look, they may be selling their home or they're refinancing and they're refinancing with someone else. We're not doing it. That hurts. It's painful. We put a lot into this. We give everyone everything we've got. But after the initial shock of it wore off, my thought was, what did I do wrong? What do we need to do better to make sure that doesn't happen with any future clients? And hopefully your friend would take it in that vein and go, hey, I dropped the ball. I didn't deliver for David. What can I do differently to make sure it never happens again?
No, absolutely. I mean, it's about learning from it, right? And I think, if you're upfront and can tell them what you're not getting, that'll make them better and hopefully it allow them to improve on the next one. But guys, we're pushing 2 hours, over 2 hours. In fact, we're going to go here, although we still have a lot of people on. We do this every Wednesday from 5 to typically 7 o'clock. So 2 hours. We will be here again. If you're watching this after the fact, or if you still have questions, put them in the comments. We'll address those topics. And a lot of times they make good videos, right? I mean, that's where a lot of this content comes from. So we appreciate you watching, appreciate you being here. If you haven't already, hit the like button, let people see it. If you're watching and you're not subscribed to myself, hit the subscribe. I try to put out good stuff that I think you guys can benefit from, educate you. And check out Josh's channel as well. It's Buywise, Borrow Smart. I don't know if it's in the description or not. I can't remember if I put it in there. If I didn't, forgive me. But if you search Buywise, Borrow Smart, 4 words, you will come across it. Subscribe there. Josh, any final words?
No, do your research, ask your questions. If it's not here, just get with an expert and make sure you're getting your questions answered. And if we didn't get to you here, there were a lot that we are not able to, don't wait a week. Shoot one of us an email, shoot both of us an email. We'll chime in. We'll get you the answers you need.
Yeah. And if you do need a lender, you do need a real estate agent, you can go to that link right there. It's also in the description below. Click on it, connect you with a pro, and get you moving in the right direction. All right, guys, have a great day. We will talk soon. Adios.